much equity. You cannot too little. We did have too little before. Let's show you again. Okay, we did it before. Remember, you guys rescued this bank for so many ways. Okay, in the beginning, we say this banking and the other banking state is high capital and low capital bank. They did the same thing, right? It's meet the requirement reserve. So 10%, and then this one put ample, means a lot of reserve. So when people withdraw the money, like you and me, we all suddenly, let's say, hypothetical, run on a bank. That's what they did during the 1929 financial crisis, which you call Great Depression, all right? That moment, people run on the bank. They just go to the bank, ATM, in that moment don't have ATM, just go to the teller, withdraw money. If we all withdraw the money, the bank cannot survive. You just see this example, right? So this is just showing you, we all withdraw only 10 million. When we withdraw 10 million, this bank just becoming insolvency. And this bank is okay, can survive to another day. So this bank will become a liquidity problem, right? So we did that. We manage how many things. Now we say is this one, okay, banking capital problem. So we go there, we're talking about a banking problem, okay, so the capital. So what is happening to bank adequacy management? You're watching this, okay, this is banking, okay, similar like before, let's say high bank capital, low bank capital, okay. So this banking, like we say, is like a similar banking. They do similar business, okay? Like JP Morgan and Citigroup, but they almost twins, only different manager, different style, but they all manage the same thing, okay? So this bank have 90 million deposits, okay? And then you have bank capital, 10 million. So this bank is have 96 deposit. Banking capital only 4 million. Okay, only different, rest the same. Okay, so you can see they meet the required reserve, 10% and they put more. So that's supposed to be put 9.6 million, but they put 10 million. Okay, and this one the same thing. So assets, they did the same thing style, make loans, meet the requirement. Only here is the bank capital, means the company stock. Okay, equity value is this bank's lower. Okay, so that's the beginning of the banking situation. Now watching what happened. Like we say, during the financial crisis, many people default loans, okay, or mortgage-backed security defaulters or collapse. When your housing collapse, everything linked to housing, mortgages, mortgage-backed security, all get trouble. Because of that, watching, if a market becoming have loan value before it's 90 million, they're okay. Suddenly market it down, loan value dropped. So they all drop, not just drop my loan, also your loan, everybody's loan. So all those mortgage-backed security value dropped. So what happened? This value no more $90 million anymore. So you can see becoming 85 because loan value dropped, okay, 85. So this bank also loses 5 million from loan value. So now you know balance sheet have to be balanced, right? So if asset drop 5 million, your liability size also drop 5 million. So you can see this bank after those 5 million value, bank capital, that's a stock, right? When your banking lose money, your stock immediately adjust new information. So tell you stock dropped value. So that's why you have 5 million left. So it becoming still, you can see 95 and 95, okay? You balance, this bank is survived, okay? Now watching this bank because of 5 million loan value loss, so 85. Also this, so this 95 is 95, but this banking capital stock is negative. Remember we mentioned that stock cannot be negative. This piece is the stock value multiplied outstanding shares, but this is becoming negative. How could a stock be negative? Impossible, right? Corporation, the worst case go to zero. All right, remember this is another hint to tell you, say, remember if your owner, your shareholder, your owner of the corporation, but the corporation set up all its limited liability corporation. So they would, if you are the owner, if not set up as a liability, limited liability, then you have a liability. Then what? Then they should, the debt holder should knock your door, say you're the owner, you should pay me because your company collapsed, you own me. But because they set up a limited liability, remember how limited liability is set up in your corporate finance course? Because they set up that way, it's limited to this point, only to the corporation business, not go to your home. So if corporation collapse, all give whatever have, give to shareholder. That's it. And then selling the piece of furniture, everything possible, liquidation, whatever, but you not go to shareholders home to say you selling house, give it to me. Okay, so because of that, so this banking negative million, that means this banking is insolvency, right? And no certain things is called negative. So this banking bankrupt. So next day, if open market, that's why you understand that if you're watching the inside job, what I tell you about chapter 9, financial crisis, during that moment, that's why they worry about the next day when open market, if you don't solve this problem, this banking just collapse. So that's why they already, you watch the movie Inside Job or Too Big to Fail, those movie, they will tell you over the weekend, the fact that the people like they are not human being anymore. They're working 24/7 in the office, decide how to pay out those banking, how to make their bank survived, because next day open market will be trouble. Okay. So for example, this bank is trouble right now. Okay. So they have to find out how to, you heard about that, inject capital, raising capital, many, this is for this piece. Okay. Normally, in the past, they have the story about the Lehman Brothers, collapse. Just like I remember last time I told you Lehman Brothers collapse, how was going on. And that moment, everybody know Warren Buffett have a lot of money. Warren Buffett that moment didn't take a risk. So that's why he hold a lot of cash. Everybody know he have cash. But then he also know is in trouble right now. Then he don't want lending to anybody. So Goldman Sachs, Bearstone, Lehman Brothers, they all trying to email to Warren Buffett about borrows couple, several $1 billion to pay out them so that they can survive another day. Because remember, I told you, investment banking not qualified. Investment banking not qualified to borrow money from the Fed because they are non-member bank. So that's why they trying to find out somebody else who have cash. Only Warren Buffett have it. So what is the story trying to tell you? Said that, okay, Lehman Brothers did email say to the Warren Buffett, say, do you have some idea? We can sit down and talk a little bit. When Warren Buffett's assistant to tell Warren Buffett at that moment don't even read the emails because he don't use the technology. He just uses the hard copy mail. And then nobody opened the mailbox. So Warren Buffett just said, okay, send me the document, let me analysis. And then they emailed, attached the file. But nobody opened. Warren Buffett never opened his email in the envelope. He don't know what's that yellow box, what that means. He never opened it, okay? And then 6 months later, Lehman collapsed. And then one day, his daughter and said, Daddy, you have this email, haven't read it yet, haven't opened yet. This is from Lehman Brothers. And then the story is to say, what if Warren Buffett read the email? Then maybe Lehman Brothers may be not collapse. People are just hoping we all hoping Lehman Brothers will not collapse because Lehman Brothers collapse make everything go the worst, mark the whole global trouble. Because Lehman Brothers is a bond king, mortgage security king. They're bond king, they're very good company. But then collapse linked to so many people, linked to your money market mutual fund, everything. So, but that's people are hoping, right? So, but it's true though. That moment, if somebody pay out that banking capital inject in here, this banking will survive another day. Another day, then another policy will be changed. It will be okay. Another thing I want to tell you, since here we are talking about the loans, right? So mortgage-backed security in the financial crisis that moment, remember mortgage-backed MBS, mortgage-backed security, all the bond, all the Goldman Sachs, all the Lehman Brothers, Bearstone, they're holding those mortgage-backed security. Okay, because the rule is mark to market. Okay, every security rule is mark to market. So they hold in those mortgage-backed security. They can hold it because the firm, right? Company, they can hold it 100 years. They can hold it, 30 years until to matured. So most banking, they challenging with the regulator say, look, my bond all on the book is a potential hold to maturity. But because they mark to market, the market today is tank because all the housing market is troubling. So you had to market to as the market value, even you intended to hold to maturity. Remember, if you hold a bond to maturity, should be at a par value, right? But now you mark to market and then you market to whatever market is. So market at moment interest rate go to the roof because the credit spread spiking. All right. So the bond price tank to, almost nothing. So now all those banks have to write down. That's what I mean. Write down their loan value. Write down the mortgage-backed securities assets value, even though you want to hold material. So because you write down, suddenly your banking worth nothing. Okay, that's how the mark-to-market people are also challenging, say, why you have to mark to market? Can you change it back to market to maturity that way? But then this would change it from previous problem. That's why they change it to market, because before many bond trader will be do something, say, oh, this is trouble, but then they say we are hold to maturity, so you don't market to market. So they change the rules, say everything must be mark to market. So when you change your mark to market, the good bond also temporarily lower the value, and that's also make a banking collapse because they have to value with the market. So people say if that moment, okay, during the financial crisis, people suggesting say that change the rule mark to maturity for certain bond we intend to hold a maturity. Then if that rule changed, some bank won't be default. Okay, so this is many things is like a becoming regulator, a policy, whatever. And then later on, they did take over. They after take over Merrill Lynch and Bear Stearns and Les Lehman collapse. Then Merrill Lynch, the Morgan Stanley, and the Goldman Sachs really is converted to the commercial bank, and then Fed can bail out them, and they survived. So still rule change in the between. Okay, so a lot of story regarding here to inject capital banking capital, go to zero negative. That means the banking insolvency. So many things involved there. Okay, so anyway, we just gave you some of the story, but then you have more thing to do. Okay, so what they're trying to say is writing down an asset value same as a haircut. No. Okay, haircut is this one. Okay, haircut is repo, right? Remember we talked about repo. Is I promised you I will buy back tomorrow. That's called overnight repo. So when I buy back a repo, let's say if I give you selling to you treasury today. So treasury have 100 million treasury at a par value. So I promise buy back tomorrow is to buy at 101 million. So I give you 1% of an overnight interest rate. Okay. So you have my treasury. So if I'm not there, you can I'm not coming back tomorrow. If I default, you can sell in my treasury in the market, you still can sell in fair value. So you're okay. Okay, haircut is like this. So if I do repo with you use treasury, very liquid, everybody wants this, it's okay, easy to do it. It's no problem. But if I finished my treasury, I have no more treasury to do the collateral repo anymore. What I'm gonna do? I'm gonna use my mortgage-backed security. I have other assets, maybe AAA. But even AAA mortgage-backed security, but still it's not a treasury. Treasury is so liquid, everyone wants it. So it's just like money, right? So, but the mortgage-backed security, even AAA, not as liquid as treasury. So people who want to do repo, your counterparty will say, look, this is mortgage-backed security, not a treasury. So you give me, I have to have a haircut. So that means if you want to borrow $100 million cash, I will charge you 5%. So all you're just doing this way is you give me 105 mortgage-backed security, right? I give you 100 cash. You see? So that's called haircut, okay? Because your assets as a collateral is not liquid as mortgage as the treasury security, okay? Write down means value just like this loan, okay, 85 million. Before it's 90 million, but right now loan value write down to 5 million. Although you hold it to maturity, but still you mark to market, you don't sell it, you just mark to market. Nobody sell. Let's say even this another thing come out. So Citigroup had one time just nobody, they all have CDOs, okay, collateral debt obligation, those pools like a mortgage-backed security, okay, but nobody's selling. They just based on theoretical value, mark it down. That's what they write down. Okay, write down. They don't selling it. They just write down based on market estimated price. They say, okay, write down 5 million. Everybody write down 5 million. So but because Citigroup had one time selling CDO, selling very cheap, I think selling at $1 of 22 cents of $1 means very cheap, almost 80% of money down, right? Loss. So then suddenly market have value. They all market at that value because that's very liquid asset, but suddenly have one market price. So making everybody depressing because everybody have to base on that value pricing other assets, pricing they holding the security, okay? So that's what it called write down, but it's not the haircut of the collateral. Haircut collateral, it is like I gave example, 5% more you need to give to me because your security is not liquid. So for more illiquid assets, they will have more haircut. So that's how they lend you money. Okay, so that's what it means. Well, very good question. Okay, but that's what this course about. This course not about just theory. This course about everything touch our real world. It's not from this course learn that. This is from the real world what you learn. So that's why when we touch something, give it some flavor, and then you're going to be deeping more about what's going on. But here at least you touch a bank capital. Say for this bank, that's what the loan value loss because of housing default. Housing default, the mortgage, you remember, delinquency, one month delinquency, and then it's called a 30-day delinquency, 2 months, 60 days. So then once you have delinquency information come out, housing market already tell you have trouble. Immediately securitization those assets, those like mortgage-backed securities will be drop value. Then same thing, loan value, because loan they immediately reflect that have default increasing, loan value will drop. Why drop it? Because when you do the loan, people buy loans, people buy at a cheaper. Remember, you can sell in loan, you need cash, market immediately know what's going on. But if you didn't sell it, they just based on theoretical analysis, still pricing down, right? So you have to pricing down. So then your auditor, everybody have to challenge you, analyst will say. So that's why your bank capital dropped because your loan value dropped. So in this case, it's bank capital. In this lower bank capital, this banking right now is trouble. Okay, then we will go say, why this low bank capital, this is CEO, why they don't like a high bank capital CEO doing the same business? You were thinking, what is this dumbing of this CEO, he's not smart enough doing this way, risky of the banking, but actually this bank have their thinking. Okay, that's why we need adequacy. Means this banking, this CEO put this position, maybe have their reason. Okay, so that's what we want to see what's going on. Before we understand what's going on, we have to understand some term, then we can understand why capital have to be adequacy, not too much, like this is too much and this is too little. Too little bankruptcy, too much, you will see why too much is not good. Too many, like this one, abundant capital, why it's not good? Why have the adequacy, okay? So that's, before we go there, we have to learn a couple of terms. Somebody know, somebody do not know, but then follow, okay? In order to manage your capital adequacy, as a CEO, you have to understand a little bit about your company's return on assets, okay? Return on equity. Okay, those are very popular terms. Remember the balancing? So your return means your earning, okay? So earning also called net profit. So of course, net profit always after tax. Okay, so after tax, that's called earnings. Suppose earning per share. You heard about that. Okay, so company profit, okay, comes in earnings, then divide by company's assets. Means all in of company's assets, then per dollar, how much give you profit, and that's becoming called return on equity. Okay, so for example, in our balance sheet here, let's use this example. Okay, assets is total 100 million. Okay, hypothetical, write down what I said. Let's say this company net profit after tax, means all in, everything all considered, the net profit, let's say is 10 million. Okay, 10 million net profit, write down 10 million. So the company's assets totals 100 million. So what's the return on asset?
10%.
10%, very good, because net profit 10 million and assets 100 million. So this company return on assets is 10%, very good. Okay, continue. Since you have my number, net profit, so what about the high capital company's return on equity? Let me show it again as well, okay? You know company's net profit after tax. Based on the formula, let's say you do both, okay? Do this high bank capital's return on equity. Then do this one return on equity. And write down that number, we're gonna use it, okay? So I say net profit, I give you formula again, okay? Let's say where's the formula, okay? So I give you company's net profit after tax is 10 million. Okay, and the table will tell you the assets total of the company, both company is 100 million. Okay, but for equity, high equity, that one is 10 million, low equity is 5 million. Okay, you do both, calculate both company the return on assets, return on equity. Okay, just we're going to use it. You do it right now. Okay, so what's the return on equity on high capital, on low capital? Low capital, high capital. What's the ROE on this one? Let's go there. I want you to give it to me, okay? Because this is a very important piece here.
Would the return on equity for the high bank capital be 1?
Equal to 1. Okay, so that means 10 million divided by equity is 10, right? Equal to
Right.
1. So very good. So this return equal to 100%. Okay. So what about the low equity? So equal to still earning same, but this one is 5, right?
Isn't it 4?
Return on what's the equity in the beginning? What was it for? Let me look at that. It is the second low capital bank. That one it is 5 million, right? Yes or no?
No, it's 4 million.
Is it 4 million? Oh, it's 4 million. Thank you very much. Appreciate it. Okay, very good, very good. That's why I needed you, right? Okay, so equal to what?
250%.
Very good, 250%. Okay, very good. Let me see. Okay, 0%. Very good. Okay, see, very good. Remember, if you're an investor, let's say tomorrow I give you 100 million. You're going to investment. What are you looking at? What are you first looking at? You want to pretend to invest your money.
Return on equity.
Thank you. Exactly. Thank you. Exactly. Who do not looking at this number? Everybody first thing will be, of course, you're looking at PE ratio, you look at the beta, look at everything. But ROE is return on equity, means per dollar of shareholders' money, how much they generate for shareholder per dollar. Okay, so that means in this case, if I gave $1 to this company give me 250%. All right, this one give me 100%. Assuming, remember we're looking at this is similar bond, this is similar banking. Even the similar banking, they do same business, banking business, they all commercial bank, they all JP Morgan, one is JP Morgan, one is Citigroup. Everything else the same based on ROE. You're going to invest which one?
On the low bank capital.
Exactly. Exactly. You want to invest this one. Okay, low bank risk. But you just saw it, low bank risk, low bank capital, this guy, low bank capital, this guy, you just saw it in insolvency. It's risk. You see that? Do you see the dilemma? You have low bank capital, so attractive return on equity, but they are risky. So therefore, because either way, in the other banking, you have high capital, but you waste money. You didn't make more loans. You didn't do a good job. So one is like we said, okay, we invest in treasury, make very safe, but the lower, very 0.0 something return. But if you take a high risk, you really could have high return. And that's why these two banks have trouble, right? You can see either one is not happy. That's why we need adequacy. Okay, so let's continue finish this one. We're not done yet. We just concluded low bank have ROE, high ROE. But now we can look at it deeper. So look at it again, we give a new definition. We call equity multiplier. Now leverage come out, okay? So let's see. So EM is equity multiplier. So how they did it, they define is assets divided by equity. So that means how much times, because equity, so asset definitely is higher than equity because assets equal to liability plus equity. So that's more than that. So let's see how many times more, okay? So this is becoming called multiplier, all right? So then we reorganize this formula. So net profit after tax divided by capital, which is called ROE, right? So this is ROE, return on equity. So then we open up this formula. So this is divided by equity. Now we divide by assets, assets by equity. So this is equation, same thing and this one, okay? So now we can see ROE equal to return on assets and multiply this equity multiplier. Okay, now do this again, assuming both banks have the same ROE. Remember, they have same assets anyway. They have same assets amount. They all 100 million. So that they have same return. They all have 10 million return. So ROE, assuming same, just use constant, that's it. So even the same ROE, do the same thing again. Can you find out this guy for the high capital, for low capital? Do one more time to find out EM for both banks. Okay, let me show you the balance sheet. Write down the formula. So asset divided by equity, okay? For the high bank, for low bank. So assets 100 million, okay? And bank capital for low bank equal to equity equal to what? For high bank capital. And then for low bank capital.
Oh, you mean the equity multiplier for both?
Equity assets divided by the bank capital. That's called equity, right? So assets divided by bank capital, that's called equity multiplier.
Yeah.
Okay, what about calculate both of them? Calculate high capital, low bank capital. Both are, I want to use this number and calculate EM.
So high bank is 10
Okay,
and low bank capital is 25.
exactly. Thank you. So let's go back again. Now you see the trick here, okay? Now you see, okay, we did that. So now EM, equity multiplier equal to total assets. They both bank the same. The first one is 10. So then equal to 10, okay? Second bank, EM, also is 100 million assets divided by the equity is 4. So 25. So second banking, low banking capital, that one have a leverage 25 times. So that means 25 of the equity shareholders assets. Okay, so you can see now, remember I say ROE, if ROE, the banking all same, ROE equal to ROA multiply EM. That's the formula, right? So you can also tell, say, second bank have a higher EM is higher, so they have a higher ROE. Even the return on assets is same, but then this ROE is high. Where it is coming from? Coming from this this multiplier, okay? Means lower capital and then assets is multiple times, 25 times more, 25 times. So this one 10 times. So you can see this one is a big number. So trigger this ROE. That's why when you see the ROE, you will see where they coming from. ROE means where they generate extra more. So it's from leverage or from really doing good business, whatever, right? So you need to figure out that. So now our point is say, okay, introduce to you, say, you have too much capital on the for high capital bank, that one you will be have lower ROE, which shareholders are not happy, but you're safe. But for low bank capital, you have a you have the lower, you have higher this ROE, but you have a lower bank capital. You're risky bank. Okay, so that's what I'm trying to tell you. Both ways troubling. So now that's why we need adequacy. Means you needed to know what you're doing. So that's why banking CEO is not easy job. You need to know the macro direction. For example, let me try to mention this one more time. In high bank, if you, let me see, follow me, okay? Let's see you get what I say. If you from now going forward, you're expecting economy in the expansion, going to be booming. Okay, we have so much money printing, so much inject right now. Government keep give us money, right? They all want to stimulate the economy doing booming. Even in that case, which bank, if you're CEO, which position you should choose? High bank capital or low bank capital?
High bank capital.
Low bank capital. Very good. Let me see you follow. Very good. Yes. If you expect expansion, economy going to booming, won't be have the recession coming out, then you should take this one, because this one tell you you won't have loan write down, you won't have default, people have jobs, people pay mortgage, everything will be okay, will be good, it can be better. So therefore, this relatively is good choice. That's why CEO have to have macroeconomic view. But if you do this one, then you won't beat this one's ROE. You're earning not good. You're going to be trouble. Shareholder will be leave you, and then your company becoming bad company. It's not good. I remember this during the financial crisis. Morgan Stanley get a trouble, but then Morgan Stanley, when they recover, everybody booming them. Morgan Stanley still haven't recovered, still holding the bag, slowly change their model. So then they, when they booming, people make a better return. Morgan Stanley still did it at that moment, and then get the CEO change it too. They just upsetting with that. So that's still not good. You have to be more, economy moving. You have to moving. You cannot stay holding that. Say I want to be safe or don't want to do something, and then you're going to be another trouble too. So you cannot. So therefore, you can see your outlook. If your outlook is going to be recession, you should go to this high bank capital. Okay, so that's why it's adequacy, right? Okay. So adequacy, how you're going to manage it? So benefit the owners for, they just argue exactly what I just argued for you. Okay, so the banking, if you do not, so owners of the bank making their investment safe, which is good in safe way, but then you don't generate the money for the shareholder, they won't be happy, they will leave you. Okay, so costly to owner of the bank, so that's shareholder. So that's why you have to, choice depends on the state of economy, right? So that's what we just say. If you from now going forward, how you're looking at the outlook of the economy becoming very, very important. That's why, like I say, it's as a CEO, not that easy. You had to have micro point of view, okay? So that's what we did, okay? So that's adequacy we done. So you know how we argue about that piece. All right, next one. So application to tell you the real world what happened, okay? So during the financial crisis, okay, let's tell you capital crunch. So capital crunch during the financial crisis had many stages of the crunch, right? In the beginning is the Fed raise the Fed fund rate, okay? You will learn the last chapter why they're raising Fed fund rate, how they control it, okay? Once that interest rate going up, remember you guys mentioned about the ARM, adjusted rate mortgage, right? Those rate will drop, and then mortgage, you know, when interest rate going up, and then mortgage rate will going up, and then people cannot afford it because they use the ARM, ARM, okay, adjusted rate mortgage. those people cannot continue pay mortgage anymore because that's a floating rate. So then floating to the upward, interest going higher, then banking, then the homeowner cannot continue catch up of the payment. And so they starting to have default, right? So that's becoming housing problem, then becoming credit crunch, then becoming the stock market tank, everything is just follow. Okay, that's a lot of problem there, okay? So you can see that the shortfall of the banking capital, which we just see it, lead to slower credit growth. Imagine even the first high capital bank, the second bank already bankruptcy, okay? The bank negative capital, that bankruptcy already. But the first one, good high capital bank in that one, even the shortfall of the bank capital, they're gonna worry. Even they survived today, but they do not know tomorrow. So they won't be, if that's banking capital drop, the banking will be protect themselves. They won't make a loan. Are you gonna make a loan to lending out to loan to somebody else if you do not know yourself can survive or not? You want to hold in the cash. So therefore, that's why we call it credit crunch, because no banking going to lending. Okay, no, the banking want to be survive themselves. So therefore, credit slower lending means credit growth means nobody lending. Okay, so if nobody lending, you want to do business? No way, right? You cannot borrow money, renew the loan to run your restaurant. You cannot do any business use the loan because nobody lending. That's trying to tell you if banking capital shortfalls or dropped, banking will be stop lending to anybody else. Okay, it's because they want to protect themselves. You know, the financial crisis, they cut dividends, they do whatever they can do, and then later on, of course, they will be less lending because banking do the same thing like a human being, right? The corporation like that, it's like a human being. Economy booming, they brave to do more business, lending out. If the economy not good and they lose money already, right? So then they will say, you know what, I have to protect. That's what they did. That's what they did. They're saying here. So that's why huge loss for banks from their holdings of securities. Remember, they can holding those mortgage-backed securities. So backed by residential mortgages, that's a mortgage-backed security. So they lost that moment. Even during the financial crisis, that's why banking do not lending. So loss reduce bank capital because you write down, right? When you write down the bank capital, your bank capital is still stock. If analysts or you are individual investor, when you saw bank lose money, immediately you just selling the stock because you know this stock going to be dropped. The stock all based on your expectation of the company in the future, what they can do. Now you already see they could lose money while you're holding the stock. You just get out as soon as possible. That's why market tank very fast. So that's what the people do. That's why share will be dropped. Okay. So bank could not raise much capital on a weak economy. Just like I told the story about Warren Buffett. During that moment when your bank crunched, everybody in trouble, everybody need capital. You need a stock, you need equity stock going up, have cushion. So then your bank won't be collapsed. So they all need it. But in the bad time, impossible to get raising capital. You know, raising capital one way is the bank can just issue stock, right? Issue the shares and then raising capital. But imagine in that moment, you want to selling your own stock. Let's say JP Morgan in the financial crisis moment, everybody is clapping and old tank, some bank already collapsed. Do you think they can selling their shares in the market? Who will buy stock? At that moment, everybody want to hold in cash. So nobody buy their stock. So then if they want to raise capital, they can't. Okay, nobody buy you. So what about if they are raising capital, that's selling bonds? So it means they're borrowing. You in this financial crisis moment, you want selling bond and borrow. Remember, during that any moment during the financial crisis or during anything market in a bad time, even in our pandemic last year March when market tank, you want to raising capital, totally impossible. Why? Because everybody panic, everybody holding their cash, whatever they have it, even they don't have cash, they want to go withdraw the cash. So nobody will be say, I want this month lending you money, I buy your bond. Nobody. But people holding cash. Cash is the king at that moment. So it's very difficult for banking raising capital. And that's why I say they all know just Warren Buffett at that moment have money, but Warren Buffett very picky. Do you know at the end of Warren Buffett during the financial crisis, lending who $5 billion? Didn't lend to Lehman Brothers. Didn't lend in any other. Many banking asked him to lending to them. He didn't lend, but at the end we know he lending to somebody. Do you know who he lending to? During financial crisis? Have some idea? No?
Goldman Sachs.
Thank you. Yes, very good. How much do you know? Do you know how much he lending? Yes, very good. Yes, okay. Yeah, that's why I should ask you guys. It is true. He did lend $5 billion to Goldman Sachs. Because Goldman Sachs number one of investment banking, top number one. So if Goldman Sachs collapses, the world will be collapsed, basically, right? So later on we know, but he very smart. He lending this way. He lending to Goldman Sachs as a preferred share, pay Warren Buffett 11% dividends. So Goldman Sachs, at least Goldman Sachs get the money, right? Others cannot even get it. But Goldman Sachs pay 11% of dividend. Can you believe it? So Goldman lose a lot of money to Warren Buffett, but at least can get the cash, get the money. But Warren Buffett didn't make a lot. He collect dividend just several billions. So that's why it's great job when Warren Buffett collects the money. And when it's over, then they report it and say how much Warren Buffett lending to Goldman Sachs. But in the beginning, many people want money, cannot even get it. So at least he gave Goldman Sachs money. Then later on, Goldman Sachs want as quick as possible pay back the dividend, pay back this borrowing money, because the dividend killed them. So big the dividend, okay? But however, you needed this, okay? So banking that moment needed cash. All right, so we done that adequacy management, okay? So as a money manager or as banking, you have to be sophisticated enough to know the direction of macroeconomics and have to know the banking business, right? So everybody have to know the macroeconomic go where. That's the important part. Okay, so we done that, manage the capital piece. You see this balancing with piece by piece management, okay? We done already many pieces already, so we done the capital. Now, because banking, once we talk about loan lending, you have to talk about the credit risk, okay? Credit risk means you could have default. That's why I call credit, right? So you borrow loans, you could default. Let's say I'm lending you $1,000, then you pay me interest. The end up, this 1,000 I never get it back. It's the worst one because my principal is gone. So that's why you have to care about those, default risk. Okay, so that's why the credit risk there. So as a bank, your loan business is your major business. That's what we mentioned, right? Commercial bankers, in the 99%. Small for regular, right? 100% concentrated loan business, then 99% is loan business. Then you have to be focused on those business, how to do it, right? Make sure it's secure. So here trying to say is you manage your credit risk, you're lending loan. Before you're lending it, you need a screening, okay? Checking, okay? Looking. So let's say your class, let's say we have this many people, or you're trying to borrow a loan, right? So I want to give you a loan, but I needed to know who could be default, who is a good borrower. You had one by one. It's very difficult, very tedious, right? You could be look like risky, but you're really good borrower. You never know. So you had to screening it. It just means screening is filter it, select it based on data, based on everything information, and find out possibly it's good. That's before the lending, right? And so you need somebody, normally loan writer in the banking who lending loans, they are very experienced. They need to know many things, okay? So that's why they specialize in lending. They know their customer, Not in the past, they really know that customer, okay? But they know which information were key. For example, you're married, have 2 kids, living where, have high education, a lot of information. And you, based on your experience, you know, this information showing me this borrower is good one. So something like that way, okay, experience. So that's why the lender having employee is experienced one, okay? After lending, okay, you need a monitoring. You're lending already, so okay, you cannot say, oh, I'm lending to Joe, and then that's okay. I just collected the interest, and that's it. I'll be okay. No, you do not know what Joe use your money doing what. Maybe he can do something else. So you had a monitoring. So you had to hire somebody monitoring. So that costs you a lot. Costs you, okay. So that's why monitor after lending and enforce of restrictive covenants. Because you have to monitor, imagine you had to hire people, just like you hire detective, had to monitoring those borrowers.
Oh, Professor, do they hire personal investigators? Do they actually do that?
No, they don't. That's why. Okay.
Okay.
They normally just, they have alternative. They really now, but once you have trouble, they do. But the lending out to you and me, just regular person, they now investigate. But once you're default, they do have people investigate on you. Just like insurance, right? Insurance, when you normally you pay premium and then you okay, and sometimes you say I have the fire and a car problem. You could have problem. They will sending you investigate a specialized investigator to find out, for example, your house burning down. And they will try to investigate and say whether you're on purpose burning down. If you're on purpose burning down, insurance don't cover you. You think you're smarter, out smarter them, so then they know what they're doing. So then they hire an inspector, expert. They find out this fire is on purpose fire. It means you want to collect insurance, and so that's what. Same thing if you default. Okay, then they will investigate how it default. But normally you and me just borrowing, they just monitoring, okay? But because monitoring, just like a specialized loan lender, so then they have from time frequency, they're looking at your data and trying to find out whether you change your job or something like that. But they're not really as investigator go to see your investigation that way. However, because you have employees sometimes have to be monitoring costly because your hour half of do the job, half monitoring. That's costly, okay? So what they do this way. They use this restrictive covenants. So that means what? When you borrow the money, that moment you have documentation, legal documentation, tell you, say, if you default or you use the money to do something not as what we tell you to do, for example, you sell buy a house in this location, but you use money buy some other location, okay, different one, for example, just something you use not as the documentation stated, then you're against the law. If something wrong, then you go to jail. You don't want to go to jail. Nobody want to go to jail, right? So that's what use this legal documentation constraint to you that don't do some risky things. Okay, so then doing that way better than hire monitoring people monitoring you. Certain hours we pay a lot of money. So in this way, actually banking can save some money. Banking just trying to figure out how to save the money, but meanwhile do the job, do the lending job. So that's why it's like doing enforcement of this restricted covenants can do better job, better than monitoring, okay? So that's what one way can improve from a legal point of view, okay? So what about the other way, right? So long-term customer relationship, like I said, in the past, so right now it's everything computer, even you and me. Can you believe it? I teach you a whole semester, I never see your face, I never know your feeling, I never know you. And see, that's the whole thing, right? So becoming computer, not human being anymore. But in the past, you make a loan, your customer, you saw the movie, sometimes they go to the family, get the dinner time, they enjoy the checking, very, very friendly. It's not like banking and the customer. It's just like friends in the past, okay? So then you know your customer very well. You don't even need a monitoring. You know that family have kids go to college, you have the job changing, everything just from social life. But the banking, because we have less this kind of relationship. So right now we don't even have that many branch anymore. In the future, branch will be no more branch anymore, because you cannot go anywhere see the banker anymore in the future, right? So, but that's it. But in the past, it is good, helpful for your lending. Okay, know your customer relationship. And then the other one is loan commitment, means bank should remember we mentioned that before. Bank, if lending you student loan, commit 4 years, 5 years, and they should be stay on that. Don't in the middle of the lending calling back, then customer really upsetting, and the customer will say, I will never do the job, never have relationship with you anymore, banking with you anymore. I will move to JP Morgan, I'll move to another bank. I'm not with you anymore because you call my loan back. Then you will tell everybody that your loan back, this bank is not good. So banking better committed the loan. Say you're lending this customer 5 years, committed to 5 years. Lending this one to 30 years, committed 30 years, like that way. Okay, so can tell you how you manage this banking credit risk. Another thing is collateral. You all know that, right? So you buy a house, you need another, you have a collateral, that'd be great. You have, normally we say down payment, or you have another house, whatever you have net worth, you're richer, and banking happy to make a lending to you because you have so many things, assets there. So but worst case, they can liquidate those assets, then can cover this loss of your bankruptcy. So that's a good thing. That's why the collateral is important, okay? So that means banking can use this to protect them a little bit, okay? Credit rationing, okay? Credit rationing, trying to say is sometimes the borrower really want money. They say, okay, lend me money. I need a cash to do my business. Even you say you charge 3% interest of this loan, I pay you 4%, but I still want this loan. The more you urgent like this, banking should be rationing, control it. Say, you know what, this kind of borrower, even they willing to pay more interest. Remember, I'm the bank. I want to make more money. I want higher interest. So that's what I should be happy, but as a banker. But no, rationing means the more the people willing to pay high interest or mortgage rate or loan interest rate, whatever, the more you should away from this person, because this must be risky. So rationing means don't give the loan to this kind of person. Even you can make a lot of money, but it's so risky, don't do it. So the other one is rationing is, yes, you can make a loan, but this guy want to borrow 100 million, all right? But don't give 100 million as what this guy wanted. Give a little bit, just give half. Let's say give you 100 million, give 50 million. Don't give all, because you do not know what's going on. So that's called rationing. Control a little bit, less than what the borrower wanted or wished. And also the risky borrower want to pay high interest. You don't give to this person's loan at all, because this may be risky borrower. This is just tell you the skill, how you make a lending, okay? But still you protect, as a banker, you protect your business. That's why you have to make the loan very selective and very picky, and also less, okay? Not give more. That's why you go to really buy a house, really like that. They really want you put a more down payment and then very picky and high interest and everything. So then they protect themselves. That's the whole point it is, okay? So many ways. This is just highlights about the banking, how they should do. But if you talk about, imagine JP Morgan's $2 trillion business, it's very difficult. And each branch manages their branch business. So each branch have a lot of activities, right? So that's why it's not easy. Okay, so we manage the loan, then have credit risk, and you do know, I'm not going that fast, okay? So, I mean, I'm just mentioning a little bit of this piece, okay? Banking have nothing else. Banking, like I said, if you get a job working at a JP Morgan, working at any banking, you go there, they don't give you that much things, and not like have tools, have everything. You just go there, you are big human capital. That's it. You is the one. You are the tool they use, basically. Then everything else, you give one computer, and then one desk. Right now, everybody working every location don't even have a desk anymore, just conference or whatever, but you just have laptop, okay? That's it, because you are the human capital. And that's why banking pay you money more, because they don't have anything else cost, just a human capital cost, human cost. So banking have other things is just the interest rate related assets, right? Loan is related, right? We say majority of the loan is the bank business assets. So loan is related to interest rate, right? Then you have a security, then banking holding treasury, that's linked to interest rate. And you have a multiple security, that's linked to interest rate. So basically banking really have business linking to interest rate. Okay, so that's why interest is very important. So banking must be managing interest rate risk. Okay, so now watching here, here's a little tedious, difficult, but this is in the exam, and it also is interesting, very important piece. Okay, I can be slowed down if you have question here, but then let me slowly introduce to you. I give you a sense about banking, really except your human capital, the rest of the debts, all the assets, liability, all linked to interest rate. So they do have interest rate risk, okay? So in order to manage those risks, let's just look at this simple, this banking's balance sheet, okay? Then we can understand what's going on. Okay, let's see this banking assets. So banking assets, they have rate sensitive assets, okay? So they just group this way. They want you see this banking a little easy, simple one, because we want to do the analysis. That's why they do this way, called rate sensitive assets. It means everything related to rate sensitive means short term. Normally it's short term, okay? When interest change affect to the security, that's why it's called sensitive, okay? If a tiny change in interest rate and this asset's value will change, that's called rate sensitive assets, okay? We'll talk about more about that, but now just understand that tiny change in interest rate, your assets value will be affected. That's why it's called rate sensitive assets, okay? And then so this banking have 20 million, all right? Then they have variable rate, means variable rate, remember floating rate, and the short-term loans have something else, okay? Then they have short-term security. See, they don't even tell you how many, just don't worry about that. And then they tell you just some other assets, but nothing regarding to related though, very sensitive one. It's not that very sensitive. For example, you have bond hold to maturity. It don't sensitive at all if you hold to maturity, okay? But leave there, just say nothing you need to worry. And next one is fixed rate assets, okay? For example, bond mature in 100 years, in 30 years, so they have 18 million, okay? And they have other things they don't even tell you, just tell you something important piece linked to the interest rate, okay? And that's it. This is the assets piece. Then look at the liability, okay? Liability, you have rate sensitive liability is 50 million, okay, in this banking. Then you have CDs, CD, you know, by the term going to be mature, and you can worry. So that's nothing you can worry about now, okay? Then you have fixed rate liabilities, 50 million, okay? And the rest of it, they have others, they don't even show you, means nothing related to sensitive on the interest rate, okay? Sensitive means now, if something happens, they will happen to the value, okay? So that means you only worry is here. So rate sensitive assets and rate sensitive liability, okay? Based on this bank, just watching what's going on, okay? So this is your bank, balance it like this. Now let's say this way, tomorrow, or from now going forward, 1 month later, or you can say 1 quarter later, whatever, just from now going forward, let's say hypothetical, we expected interest rate will going up. We all know now, right? You hear right now, everybody talking about it. We're going to have inflation. Interest will going up. You saw the couple months, a couple of days, weeks ago, the market tanked on the technology side because the inflation coming, because you know, interest is going up. Just like that. Let's say we expect the interest going up from now going forward. Based on this balance sheet, what this is your balance sheet, for example. What's going to happen to you? What happened to you? You're going to make money or lose money?
Lose money.
Why you lose money? Tell people.
Because I have so much rate sensitive liabilities.
Yes, very good. You're all right. Okay. Yes, because this bank, if let's say interest rate going up, change it. Okay, going to change it. Let's say 3%. Going up means change it, increase whatever right now is by up 3%. Then your liability in this condition is you pay 50 million multiplied 3%. That's your liability. You had to pay out, right? You had to pay 3% multiply this value. But your assets only 20 million multiplied 3%. So net, your result is you pay more. You agree? You know what? Let's see our numerical number, okay? So 3%. So 20 million in the assets, million multiply 0.03. So this one equal to what? You gave to me. And the liability is 50 million and multiply 0.0 increase. The liability equal to what? So 1.5 million. You agree? I'm wrong, tell me, okay? 1 million. Yes or no? This one equal to
0.6.
Very good. So remember, this is liability you're going to pay out. Pay, I do this way, negative, okay? And this is the asset you have increased as positive. So net result is what? You lose how much? So let's say 0.6 minus 1.5 equal to
0.9.
very good.
Yeah, negative.
You lose. Very good. You lose money, right? Very good. Now I'm gonna ask you. So what do you do? So then how you allocate your balance sheet so that you don't lose money? How are you gonna do that? Let's go back to balance sheet again. Okay, so very good. You follow me, you win. Okay, very good. So now because the banking balance like this, we know if interest is going up, we balance it this way, we're gonna lose money. So what are you gonna do? You handle this balance sheet. What are you gonna do?
I'll increase the rate sensitive assets.
Thank you.
And reduce the rate sensitive liabilities, or
yes.
reduce those. Yeah.
Exactly. Reduce it. Okay. Very good. Now how much? I say if you okay, go ahead. Just do it. Yeah, your direction is right. How much can you do? You do so good, then you can see how you can do better. How much?
Okay, if I were to increase the rate sensitive assets, I would bring them at least to 50 million.
Very good.
And if I were to reduce the liabilities, I would reduce them to at least 20 million.
Reduce to 20. Very good. Yes, exactly. That's exactly okay. So then you can sleep because then what happens if as long the equal, so the assets, rate sensitive assets equal to rate sensitive liability, as long as equal, you can sleep. It means you don't worry. You don't worry at all about any interest rate change. We say interest rate going up. What if interest rate going down? Okay, so in you do the equal, doesn't matter going up or going down. I hedge it. You hedge it. You means you don't have any knowing, no panic overnight. It's nothing gonna affect you if interest change. You hedge it. But you say, I want to make money, just like before we talk about the adequacy, right? But I put it this way, I'm betting on what? I want to make money. So again, see, because you follow me very good. So follow me again. Let me say, if you put a position like this, what are you betting on interest rate movement? Go to which direction interest rate? We just say we choose increases 3%, then you lose money. So you're betting on, you position this way means you're betting on interest rate doing what? How about this? You don't get what I'm saying. What about, let me ask you.
You're betting on a decrease because you'll be paying out less money.
Exactly. Let's do this. Okay, let's do this. Let's say if from now going forward, everybody say interest going up, but you say, you know what, you do research, you know that. You say, no way, impossible going up. So let's say interest rate you believe from now going forward are going down 2%. Okay, let's go back. If we believe interest rate, you believe interest rate going down 2%, okay? So before we say 3%, now that's, I do this way, retyping again. So for this asset sensitive piece, assets, okay, this time do better. Assets piece is 20 million, we have it in there, but you say interest rate going to be down negative 2%, okay? So that's asset piece, okay? Then we have a liability piece. I just do L now, okay? So then you have 50 million and multiply, same thing, negative 2 million, okay? So now get each result. Remember, one is, I will tell you what one is, this is liability piece, okay? So this one equal to what?
Negative 0.4.
Negative 0.4, very good. Negative 0.4 million, okay? And assets will be dropped. So liability, negative
1.
Was that 1?
Yeah.
1 million, very good. 1 million, okay? But remember, this liability is dropped 1 million, it's you paid, okay? This one you gain it. Do I make things right or wrong? Oh, go our formula. Go this way. Go our formula here. So assets minus liability, okay? So equal to 0.4 million minus negative 1 million. So your result gain equal to 1.4 million. Are you follow me? You agree? You agree?
Yes.
Okay.
Yes.
Okay. So that means when interest rate going down, drop, you're betting based on that balance, you're betting on interest rate going lower, not going upward. So upward, you lose money in this scenario, okay? But going down, actually, you make money. That's why you're betting on, in that position, you're betting on the direction of interest rate is going lower, okay? In going lower, you make money because it's really sensitive. You're going to pay less. You're going to pay less interest. To drop it before you pay that much, now you don't pay that much. So drop 1 million. So this one gain, so that net result, you make money, okay? So this is a balance sheet you play, and then you just hedge yourself. If you don't want a better direction, you don't care, you just want to be hedged, then you choose the equal amount, rate sensitive, equal amount. That means you totally remove out the interest rate risk in this rate sensitive assets and liability. Your balance sheet at least protected, okay? So, but you don't make money either. You just saw it. If you are bad, you're equal. Okay, but if a better direction, yeah, it make this different kind of way. Okay, so what do we just do that? The formula, what do we calculate? Called gap analysis. We just did it. Okay, we just did a gap analysis. That's called gap. So rate sensitive assets minus rate sensitive liability. Okay, and I did multiply the interest rate. I did it separately and then net out. So you can do one in one formula. Multiply, like I have a 3% increase or 2% drop. Multiply that, you get the net change of the banking, this rate sensitive assets and liability net profit, okay? So this is the gap formula, we just did. That's the gap analysis, all right? So you use the formula again, you can see, go back again, you just use the same thing, what I just did, okay? So I did piece by piece, okay? Now you can directly, you don't need to multiply interest rate, you just do this assets minus liabilities and then multiply the interest rate. So you don't need to have to do this way, but you do, so the same thing, that's gap analysis, okay? So that's what we just did. So simple way, but tell you how you analysis your rate sensitive security in your bank balance sheet, all right? So we done that piece. This is a little bit, this is a simple piece, but you can see the balance work, okay? So next one is the same logic, okay? Becoming maturity bucketed. So what that mean? You remember that assets, see this balance sheet? Okay, have many security, okay? Many liability. So what they do, like they did this piece is read sensitive assets and the liability, this piece. But you can do like assets in the similar weighted average the maturity in the bucket. So that means in this bucket, for example, have 10 assets, have 5 years maturity, have 2 years, have 10 years, and then you will be weighted average, let's say it's maturity. We will talk about that or the duration more soon, okay? Let's say just weighted average maturity 8 years. And then you choose the same thing here, liability, choose the weighted average, those inside have many security, and then you weighted average 8 years. Okay, so 8 years, this one match on this 8 years. So this piece, at least they hedge it. Means this piece is just like we just did this really sensitive liability, put both equal. You don't buy the direction, for example. You just put that equal, but then bucket to bucket. That's what I mean bucket, okay? A group of assets and a group of the liability on weighted average, the same maturity. Okay, so then becoming hedge out means this one don't affect you. Imagine you're running billions dollars banking, the balance sheet is so complicated. You can only group by group, like call bucket to bucket. Okay, that's what I mean, bucket, okay? So this is what I mean, bucket. So then you do that approach, you do the same thing when we do the gap analysis. You can bet on direction or you just hedge out. Okay, so that's what we did that one, okay? The last one just to say, okay, standardized gap analysis is just normally becoming all kind of a really sensitive security analysis, put group by group. Banking definitely will do the gap analysis, right? Because it has so many security and assets and liability, so many things really related, okay? This piece a little bit difficult, but this formula is definitely showing up anyway. So I will talk about this, but then I just clean up of the formula, that's it, okay? So this is percentage change in market value of security, for example, bond, okay? This is why they couldn't type in it. It's almost equal. This is almost equal, but then showing up becoming just almost equal. It's because not 100% equal, because this is the formula I gave to you, but they cannot. So almost equal, okay? Equal to what? Equal to negative percentage point in change on interest rate, okay? Then multiply duration. I will talk about this piece and I'll give you a formula right now, see whether you can use this formula, but then later on we'll do more about this piece, okay? Here's a formula. So you can use that word, it's pretty much difficult. Let's see, I can do that, okay? So change, okay? Well, this may be also difficult, say change. I will do better formula next one, use word, okay? Change of this security price divided by the price, become the price percentage change, right? And equal to negative, you just do that duration and multiply change in the interest rate, okay? In interest rate. I will give you better formula next time. I just use the word to type in for you. Same thing again, this is not easy. Remember the equations are almost equal to, because they're not 100% equal. So we'll give you more. So use this one, we'll have to talk about duration, okay? And then how to change, we're going to exercise. So we gap analysis and also this duration analysis must in exam, okay? So that's why you should be pay attention here. So we'll talk about next time, okay? We have plenty of time on this, don't worry about that. So any question? All right, so, okay, so then talk to you then next